Welcome back to Growth Without Referrals. Today I'm joined by Chris Reid from Cardinal Capital. Chris and his team specialize in helping businesses gain access to capital, especially in situations where traditional financing alone does not get the job done. What stood out to me about Chris is the way he describes financing, not as a straight line, but more like an assembling a Mr. Potato Head. Pieces everywhere, sometimes upside down, sometimes sideways, but eventually coming together into something that works. Chris, welcome. Glad to have you here.
Mark, thank you for having me. Really appreciate you inviting me on your podcast.
Excellent. And Chris, let's start at the beginning. Every business leader has that moment where they step into their industry, sometimes intentionally, sometimes by accident. Walk us through your path into banking and capital access. What pulled you into this world originally?
Yeah, so my degree in college is actually in finance with a concentration in commercial banking. Unfortunately for me, way back when people rode dinosaurs to work, when I graduated from college, the banking industry was in a very rough time here in Louisiana. We joked that we should wear Velcro name tags with the organization of the bank because one couple of months it would be one bank, take that name tag off, it's a different bank, and I think we changed signs of the name of the bank 3 times in 1 year. So it was really, really difficult. So at that time, and that was back in the mid-90s, I exited banking. I just went away from the banking industry completely. My parents had a mortgage company up until Dodd-Frank of 2010 that they were operating, and Dodd-Frank kind of legislated them out of business. And at the time, I was working as a financial advisor and just thought businesses get some terrible advice. So I was like, okay, how can I help businesses? Where can I do this? And as a financial advisor, I would ask questions like, okay, if I found a briefcase of money hidden within the 4 walls of this business, can we split it 50-50? So I got into doing a lot of tax credit work, a lot of state tax credit work, things of that nature. Got involved with a group called Sense here in Baton Rouge, Louisiana, that was running Baton Rouge's version of Shark Tank, and I got heavily involved and actually became chairman of their organization at one time. But myself and my business partner would sit in the back of the room like the 2 old guys on the Muppet Show. And as these entrepreneurs would pitch, we're like, you don't need equity, you need debt. But the banks here are so conservative in Louisiana that it was very, very difficult. So we said, you know what? We should be able to do this. My partner at the time was working for the Kauffman Foundation, which is a huge entrepreneurship driven organization. They sponsored Global Entrepreneurship Week. And so we decided, hey, we should join forces, create a business, and begin brokering loans. And I was doing it on a part-time basis. And pretty soon, it wasn't long where I was making more money brokering loans than I was as a financial advisor. Left my advisory capacity. He and I started Cardinal. We brought in a third partner, and it's been that way for the past 11 years. So it's been one heck of a ride. It's been a lot of fun. There's been a lot of ups and downs, a lot of lefts and rights, but it's been a great time.
That's great, Chris. What a great story. What did you learn early on that most people misunderstand about financing?
What I learned very early on is that their bank was there to lend them money. And the running gag is banks only lend money to people who don't need it. The issue being, for most of them, they didn't know that their bank didn't do something. A lot of small community banks don't do equipment loans. I didn't know. A lot of small community banks only want to lend in real estate. Okay, that's great, but now I need inventory. All banks hate inventory. Well, how am I supposed to put goods in my store to sell if the bank, how do I do this? What's happening? And so there was a lot of that was coming about. The other, probably the biggest one is, and this is pandemic level here in Louisiana, CPAs are lazy. I hate to say this, most bookkeepers are really bad about this. But if you start a business, and let's say, Mark, you have this podcast business, you put down $250,000 into this podcast business. You build your studio, you do all this stuff, you use your money. Well, now all of a sudden you need to start growing your podcast. You want to do just this, but you might need multiple studios to invite guests in studio and do some things. Okay, well, I'm going to go to my bank. Your bank's going to look at your financials and go, well, Mark, you don't have any equity in your business. What do you mean an arm and the equity? Took $250,000 and put it into it. Where did it go? Your CPA or your bookkeeper expensed everything. So they didn't take those startup expenses, that
Oh,
250,000, put it as an asset on the balance sheet, and then amortize it, let's just say divide it by 5, and reduce that by a little bit over a 5-year period. Instead, they said, okay, well, you paid the contractor, you paid the utility company, you did all of these things. And so now, again, balance sheets are assets plus assets equal liabilities plus owner equity. So now you got no assets, you got liabilities, your bills and other things. So where's the negative? Owner equity. Now you have a negative owner equity, and the bank's like, hold up, we're done here. And so many solo entrepreneurs or people starting businesses out of their garage, everything's expensed. So therefore, they have no way to show the equity that they put into it. Sorry. The same way, too, that they don't know the difference between their personal credit card and a corporate card. They use their personal card for the points, but then their personal card gets to a point where they want to refi it. Well, how do I know that you went to Sam's Club or Costco for the business and not yourself? Well, trust me, you got to take my word for it. Yeah, we don't trust anybody here at the bank. No. And so what do? The other thing is that in my area, which is in Louisiana, we have a running joke that says no lot loans, LOT, and that stands for Louisiana, Oklahoma, and Texas, such that when oil goes down, the banks say that's it. No loans in Louisiana, Oklahoma, or Texas. Done. And so how are you supposed to know that happened? The other thing is that if you have a loan in Detroit, Michigan, you're an auto manufacturer, you stamp car parts. You go to the bank and you go, hey, I want a loan. Business is good, everything's great. Bank looks at you and goes, no. Why? Well, the regulators say we have too much concentration in the auto industry. No kidding, you're in Detroit. What do you expect? Sorry, can't do it. Same thing too with an oil and gas loan in Texas, Louisiana. The regulators say we can't do this. Well, how are you supposed to know that the regulators ran the bank and not the bank running the bank? No way for you to know until you apply for the loan. All of a sudden you're turned down and oops, now what? Where Cardinal comes in is I can take the auto loan in Detroit, bring it to a bank here in Louisiana. Those banks don't have auto loans. We don't do auto manufacturing in Louisiana. Oil and gas loan goes to Detroit because their bank doesn't have any. So therefore, it's about keeping regulators happy. Think of it as a pie chart in your 401k, small cap, mid cap, large cap stocks, real estate, whatever. That pie chart, the bank has the same thing. If the pie chart gets out of balance, they got to quit doing loans. Believe it or not, most banks can only do one loan on a hotel every year because the regulators have really kind of put the grips to them. So
wow.
it's different. All this stuff you learn in the background.
That's
The other piece that what makes it not linear, Mark, is banks are measured against something called their loan to deposit ratio. Healthy banks want to be in the 70s. Uh, Unhealthy banks, 80s, 90s, some of them are over 100, meaning that they have more loans outstanding than they do a deposit. So a bank, whenever you get your money, and this ought to scare the hell out of anybody in your audience, banks, your deposit is a liability to them. It sits on the liability side of the balance sheet. The bank owes you that money. The bank converts that liability into cash that goes into their general account. Your account, your money is only subject to the funds availability policy of that bank. So if you didn't read that statement, okay, maybe shame on you, because that is how you get money out of the bank. You really don't have, you have a promise of the bank to pay, but you don't actually have money there. They use that money to put in their general account to make loans and do other things. So if the bank starts to get out of balance in that loan to deposit ratio, they'll come to you and they'll say things like, you know, Mark, you really want to do this loan on this apartment building that you want as an investment property, but we need you to come in with more deposits. And that apartment building doesn't have enough deposits. Do you have any deposits anywhere else that we can have? Well, I've got some money in an IRA account. Yeah, that really doesn't work. Okay, can you put that in the form of a CD? Because the other side of it goes into our investment group and it doesn't work for us. Can you put that money in a CD? You mean a certificate of depreciation? No, I don't want to do that because I can't afford the 3% interest you're going to give me. Well, we have a special. We'll give you 3.25. Does that work? Not really. But, you know, I've had a lot of loans turned down because the client couldn't bring in enough deposits. What that should really tell the client is that bank is hurting for money, and that may not be the best place for them overall. And there's so many of them out there, but again, how do you know? I didn't know. And that's where we come in and we work and say, okay, this is what we can do. This is what we can't do, and do that. The other piece to it is of lending is there's certain tax credits that are out there for certain clients that actually those credits come in as equity. That helps. So certain tax credit programs, new markets, tax credits in particular can add up to 5% of the overall project cost. So that's something that can definitely assist clients. And their bank doesn't know anything about them. And matter of fact, 9 times out of 10, the bank has them and they just didn't even know that they even had them. They could have been left over from back in the early 2000s in some instances. So yeah, there's different things like that where we look at it and we know where to dig to go find the money. So that's what we've become good at. The other thing is, have you ever wondered why there's a 30-year life insurance policy and a 30-year mortgage? Well, guess where your life insurance premiums go? Like, they go to invest
Mm,
for those life insurance companies to invest in real estate loans. MetLife is one of the largest agricultural lenders in the United States. Who knew Snoopy made ag loans? I didn't for the longest time, but they are one of
wow.
the most of the large ranches and large farms across the United States. Those loans are actually with MetLife, not with any type of ag lender. So
Great
yeah,
insights.
we get into some very serious stuff. Some of it makes sense, Mark. Some of it doesn't. I'll give you one that doesn't make sense. USDA has a BNI loan program where you can finance a rural business. Farm is considered a rural business. However, if you want livestock on the farm, that's an SBA loan. What? And how we found that one out by accident is we had a client that was breeding champion quarter horse and barrel racing horses. And those horses had to be purchased with an SBA loan and not a USDA loan. And we had to end up going to a bank in Kentucky who specialized in loans of this nature to get it done. And that was a bit of searching on the internet and leveraging contacts to find the right banks and the right person within the bank to get it done. So, yeah, it's not always for the faint of heart.
No, and Chris, these are great insights and wisdom that you've built up over the years. And with that, you used the word gumbo, which honestly
Yes.
might be one of the best ways to describe financing. How
Mhm.
does that gumbo idea apply to structuring deals?
Yeah. So quite simply, let's go back to the new markets tax credits I mentioned earlier. So you need a 20% down payment to build this project. So what we might do is we might take a SBA 504 loan. And so we have that loan. And with that, we need a 20% down payment. I mean, a 10% down payment on that loan. So we work out the capital stack, but we bring in some new markets tax credits to cover 5%. So let's just say on a $10 million loan, I need 10%, I need 10%, which is 1 million. So now I come in with 500,000 from new markets. It leaves me a $500,000 gap. Now then, $100,000 gap, I can go to the owner of the property that I'm buying and say, hey, will you give me owner financing? Guy says, sure. Now all of a sudden, I bought that property with zero down. Okay, so now we've got a $10 million loan. I'm into it with zero down because I've got this layered in. Now it's a manufacturing facility. Okay, now what? Well, I can finance the equipment in, but what I can't finance is the inventory, and I can't finance working capital to get me going. So I might have to go to SBA 7A. And because I have an idea where I want to be able to sell my product to a company who will then take my product overseas, well, that means it's an export loan. Okay. And the SBA views those very, very favorably. So you've got to be able to work all those pieces out. So now I've got owner financing, new markets tax credits, an SBA 504 loan, an SBA loan. I've got all that put together. But then on top of that, I just need a generalized line of credit. Okay, great. We have that. I'm exporting now. Is there a way that the overseas clients can finance my product? Sure, let's go through XM Bank. So XM Bank can actually finance your clients to help buy your product and be able to get that done and provide insurance such that if that person defaults or something happens, then you're covered, your lender's covered to make that happen. That is an actual case that we did. So there was
Wow.
so many moving parts on that one, and that's what we call, gumbo, Mr. Potato Head. You just fit the sometimes Potato Head looks like he does on the box, other times it looks like a Picasso. Who knew? But at least it gets done. So, we got it done. We made it happen, which is what's most important. So yeah, there's a lot of different times that we have to go through those stages to make something happen, and sometimes there's certain time limits. And other times it's knowing who the right people are, having the right contacts. Matter of fact, just this morning I had to make an argument to a bank, and I knew to contact within the SBA. Asked the question with the SBA. They gave me everything that I needed to know. I cross-referenced that with some of the SBA legislation and some of the other things and went back to my lender and said, here's how I can solve the problem. Let's do this, this, and then this over here. I said, well, I can't do that. Well, nope, already asked that question in the SBA. Here's how they said to do it. So let's get it done. So there's that. Also, too, it's having certain relations, Mark, where I had a client of mine that took out a very high interest loan, and the acronym, it's MCA. It's what it stands for is Merchant Cash Advance. These are payday loans for businesses, very common. CanCap, On Deck, Grasshopper. There's a number of the brands that you may have heard on radio, television, internet, or whatever. These are very high interest loans, sometimes typically 36% or more, most of the time in the mid 60s. I've seen some close to 100 or
Hmm.
more percent interest. Under the Trump administration, about this time last year, they said no more refinance of these MCA loans. Okay, great. Now what do? You have this very egregious high interest loan, and how do I get rid of it? Because I can't refinance it with the and that's where we come in. Okay, we'll work with you to get it done. In some instances, again, these MCA lenders are not stupid. They have contracts to position that loan as a term loan that is actually refinanceable within the confines of the SBA. Having a relationship with these types of lenders, we can go in, negotiate with them to flip it to these friendlier contracts, which then over a period of time allows us to be able to refinance it through the SBA and meet the guidelines of the SBA and check all the boxes. So that's what we do. Now, do we provide those types of loans? We do not. 90% of my business comes from banks. If I provided those types of loans, the banks would cut me off from referrals. So
Hmm.
we do not do anything of that nature. Well, that's not a sandbox that I want nor desire to play in.
Wow. So, Chris, let's talk about growth, specifically how businesses grow. You mentioned that roughly 90% of your business comes from banks, and the remaining portion comes from unpredictable inbound opportunities. It's a very relationship heavy model. How did that develop over time?
It's kind of funny. We spent 2 years arguing internally who is our ideal customer. Now, mind you, I have a partner getting a PhD in marketing, and it still took us 2 years to identify who was our target customer. The obvious being, oh, well, it's a business with this many people and this and all of this. No, that is our ideal client. The customer is actually the bank. What we determined was it's banks. It's not attorneys, it's not CPAs, it's not anybody else, it's banks. And so it took us 2 years to kind of work through that. Now, the ideal client, okay, that's a different story. But the ideal customer for us is a bank because we can help them quite a bit. And the reason being is they have a troubled loan, we can take the troubled loan off the book. Banks have legal lending limits. Who knew my bank couldn't loan me more than $5 million? Okay, well, versus that loan going to a bigger bank, why don't I take that loan and I'll go put it with a life insurance company? So it's with a non-bank lender who's not going to mess with the deposits. Does that work? Great. Okay, perfect. I had one bank where the gentleman that was applying for a loan had too many personal guarantees. He had too many contingent liabilities on his financial statement. Young lady called me up and said, hey, can you help? Sure, not a problem. We identified a bunch of real estate loans that oddly enough weren't with their bank. We refinanced those, and when we did, we made it non-recourse, meaning he didn't have to personally guarantee the debt. Now all of a sudden those contingent liabilities come off his personal balance sheet, personal financial
Sure.
statement, and they were able to approve the loan. So by getting a reputation of how to work within the confines of the system. Over time, word gets out, people transfer bank to bank to bank, and then we progress forward. That's how we grew. A ton of people out there grow through organizations like BNI, Business Networking International. They grow through other tip clubs. It's you know most of people in a certain, especially business to consumer level, they grow quite well through those organizations. They don't last long with them only because they've outgrown it in some way, shape, or form. Other businesses do really, really well of just over time gaining clients within a geographic market. And then they want to grow and they say, okay, if I'm in my area, which is Baton Rouge, Louisiana, I want to go to New Orleans, which is about 60 miles down the road. Okay, how do I do that? Well, the question becomes, and this is where your banker's not going to really sit with you. Okay, you can grow organically into that market, but how logistically are you going to handle that and do that? Or can you find somebody that's in the same industry as you who's willing to sell their business? And so now you go come in, buy a business. It's got employees, it's got a small book, it's got something, and you go in a location and you go in and buy that business. Well, through up until just recently, and even today, SBA was allowing you to buy those businesses with no money down. You can come in and buy those businesses with as little as 10% down. And so that becomes a very strong alternative because the maximum SBA loan is about $5 million. And so therefore, I can buy a pretty good sized business through the SBA loan program and do it with very little to maybe even no money down, depending on how I do that. So your banker's not going to have those conversations. We can and we will, because how do we want to do this? So that's how we do it. And we look at it. If you go into a bank to go buy a business, 3, maybe 5 years is what they'll give you to pay for it. SBA
Hmm.
gives you 10.
Okay.
Yeah. So that's how we look at things, Mark. So how do you grow? Sometimes you just got to figure it out. But a lot of the times that organic growth is a real driver. Sometimes you have a niche, you catch something that's a niche and you roll with it. We have seen lightning in a bottle in my area quite a bit. There's a company called Marucci Bats. They started out with the head trainer of LSU. He couldn't find a wooden bat for his son, so he made his own wooden bats. And then all of a sudden, a couple of major leaguers, because of LSU's baseball program or whatever, he made a couple of bats for a few major leaguers. And then all of a sudden, boom, it just exploded. The same way, too, that a little niche company here in Louisiana, 2 niche companies actually here in Louisiana. One of them was called Presonus. So every garage band and church in the United States had a piece of their audio gear as a part of their platform. And they were recently bought out. I think the Harman Group, Harman Kardon, I think bought them out recently. Another group is a company called Mezzo, Mezzo Technologies. They make these things called heat exchangers. You and I call them radiators in a car. They call them heat exchangers. But they had their methodologies for doing it. Very quietly, every NASCAR, every F1 car, every Ferrari, every Lamborghini, every Porsche 911, they all carry and use their heat exchangers, aka radiators, and very quietly became a very large, very, great company. But we've seen a lot of companies go up. One of the best I've ever seen in my life was a guy that rented tables, tents, and chairs, made $3 million in top line revenue, put $1 in his pocket. So that was incredible. For every $3 that came in through the door, he put $1 of net profit in his pocket. So $1 million a year renting tables, tents, and chairs. No generators, no Slurpee machines or daiquiri machines, none of that. No air conditioners, because all that breaks and people get mad. If his tent leaks, duct tape is all it takes and you're good. But that guy just built an incredible business renting tables, tents, and chairs. It was amazing what that
It
gentleman
is
did.
amazing. So, Chris, you've been in this space for years and you've seen companies succeed and you've seen some companies struggle. So, here's a question for you. What is the biggest mistake businesses make when trying to access capital?
Couple of them. Number one, ad accounting. We call it you can't get paid twice. So what I'm going to do is I'm going to show on my tax returns I'm not making any money. That way I don't have to pay any taxes.
Hmm.
That's great. In small business world, because we don't have audited financials, the only thing that's a close approximation to audited financials in a larger corporation are tax returns, because under penalty of law, if you lie on the returns, there are fines, penalties, and everything else. Okay, so the tax returns. Well, you show you didn't make any money for the last 3 years. You're hemorrhaging money like there's no tomorrow. Yeah, but I make a lot of money. Let me show you my bank statements. Well, now all of a sudden, I'm going to play as the lender. I'm going to play this game called the audit lottery, which as long as my client doesn't win the audit lottery, I'm fine. However, if he wins that lottery, I'm toast because he's not going to have the ability to repay me because the IRS is going to step in and say, no, 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 you owe this. There's all these garnishments, all this other stuff. And now there's a huge issue. So that's one thing that causes people not to do it. The thing is we call them lifestyle companies. What do I mean by that? Most small businesses out there are lifestyle companies. Well, my CPA says that if I go out and I go buy an SUV over a certain weight, I can just write it off and take depreciation. Well, yeah, you can. And that's allowed back because businesses are measured on something called EBITDA, earnings before interest, taxes, amortization, like. So that's the D in EBITDA is depreciation. I can add that back. But constantly running all of the personal expenses through, well, I'm hungry, so therefore I'm going to use the business card to pay for my meal. The house needs toilet paper, therefore the business needs toilet paper. I'm thirsty, therefore the business is thirsty. And so everything just gets constantly expensed out of the business. Okay, now you want to borrow money and you're sitting here and you got yourself into a need. Tariffs. Trump came in with tariffs and that has hurt a lot of businesses because the products have gone up. All right, now what? Well, I can't get a working capital loan or a cash flow loan because all this is a wreck. Your only choice is to go to those MCA lenders with the really high interest because they'll do it based off of your bank statements, not off of real underwriting, risk adjusted. Now you're into, hey, 60% interest, not a good place to be. The other thing that stops people from doing it is, and this is even for established businesses, it kills their ability to borrow and it kills their ability to sell the business for a profit. And that's this. Well, my accountant says I needed more, tax whatevers. So what did I do? Well, I um, bought a condo. So now the business leases the condo in Florida from the business. So that way my condo in Florida is paid for. Well, I wanted a boat. So we have what we call the mobile aquatic disaster response vehicle because I needed that for my business. But really, that's the boat where I take people fishing and I go fishing. We have the mobile disaster response unit. That's my RV. So I put that into the business. I've also got my deer camp where I go take my clients hunting and I go hunting and the business pays for all of this. And so all this money's flying out of the business. But okay, that's great. It's awesome that you have the business with the financial ability to pay. But when you need to borrow money at the best rates and the most reasonable, your business isn't showing a profit because you're pulling all this money out for all this personal use. And God forbid you have to go to sell it because of an untimely death, illness, whatever, it's worthless because you're sitting there going, well, you got to add this back. Oh yeah, I forgot I had the boat. Yeah, we got to put that back. Oh yeah, I forgot to tell you, my two boys that are in high school, I put them on payroll. So versus paying them allowance, I put them on payroll so that way we can also put money in their 401k, and I put them on the group health plan where the company pays 50% of their health insurance premiums. And okay, great. Congratulations. All of that is legal. If you do it correctly, it's all legal. Just because you can doesn't mean you should. And when you need, banks only lend money, as the old adage goes, to people who don't need it. When you need it the most is when they're going to lend it the least. So, you didn't plan and now something happened. Now what? So,
Wow.
yeah.
Okay. Great insights and thank you. Chris, let's look ahead. Over the next 12 to 24 months, what changes do you expect in the capital landscape?
Some of the big changes that we're seeing, again, what we have to all remind ourselves is what happened in 2020, Mark? Long pause. What happened in 2020? Oh, this is one of my favorite things. COVID. In
Yeah.
2020, the world shut down. And again, it's 2026. This time in 2020, we were all wearing the full body suit, yellow hazmat suits to walk around to do things, but yet that was 6 years ago. And people forget. Okay, so what does that landscape look like? We're still coming out of the world shut down for a year. What happened? It caused supply chains to bust. It caused inflation to spike. interest rates, it's not that interest rates went up over the Biden administration, it was the velocity, the amount it went, how fast it went up over a period of time. Not that they went up, it's just whoosh, they went up. The same way too that under the Trump administration with what's going on in Iran, oil gas prices in particular, whoosh, went up. Okay, we don't know what's there, but we're still, believe this or not, recovering from 6 years ago of various economic policies that were put in post COVID, the amount of money that went into the money supply. Banks spent the COVID money like a bunch of drunken sailors. Okay, banks have a typically do term loans. And so the term, unlike a residential mortgage, which is 30 years, banks may say, okay, and their amortization is typically 20, I'll give you a 20-year loan with a 5-year term, meaning it'll balloon in 5 years. 5 years ago, it was COVID. I mean,
Mm,
6 years ago, it was COVID. 2021, coming out of COVID, rates were still twos and fours and threes. All those loans are renewing. And while they appeared to be good loans then, and the banks did stress test them as required by regulators, that stress test wasn't enough. And so now that rates are in the low sixes, prime is at 7.25 and whatnot, a lot of those loans aren't cash flowing. And so now there's a huge problem, especially in investment real estate world, where you've got a bunch of loans that aren't cash flowing. And those are all
mm,
coming due. And it's putting the fear of God into lenders. The other piece to this is coming into 2020 and 2019, 2018, 2017, one of the best things for people to invest in were office buildings. Guess what they're not investing in? Office buildings. The reason being, in a post-COVID world, people are not working in the office, or they're only coming in 2, 3 days a week or whatever it may be. So office buildings are now being repurposed, redeveloped. But at the same time, a lot of those buildings are going into foreclosure. There's one in particular that I know of in New York, one bank, Natixis, lost $3 billion on one building. So the landscape is kind of changing. And as a result, loans have tightened up. Whereas some lenders, you were able to get a construction loan for 80%. Now it's all the way down to 65%. So if you want to build that building, it's $1 million. Yeah, we'll give you 650,000, but you got to come up with the rest. So it's really kind of put a lot of pressure on builders, developers. I've got a manufacturing project. It's an $80 million project. That particular project, we had to have 50% equity. So $40 million in equity had to come in, with the other 40 million in debt. We were able
mm,
to accomplish the task, but it wasn't without a lot of wailing and gnashing of teeth, and it was a little rough. So yeah, those are the changes. The other thing is fintech AI is getting better and better and better, doing balance sheet analysis, income statement analysis to make certain arguments. AI definitely is helping make those arguments and get things done and accomplish that task. And then there's fintech, new loans. So most people are, a line of credit at a bank is based off of your accounts receivable. Hey, people owe me money, therefore I can borrow against the money that they owe. I actually have lenders that will lend on accounts payable. So
mm,
I owe, let's just say, air conditioners for this inventory of air conditioners that I bought, but Train gave me 30 days to pay $1 million for the inventory. That's it. That's all they would do. Well, now I call Chris, one of Chris's lenders will give me an extra 90 days after the 30 days are up. So now I've got 120 days to pay off the air conditioners and get that done. Yes, there's interest. Yes, it's not exactly the cheapest thing in the world, but if you're an air conditioning company in South Louisiana, it's very, again, seasonal because we have very mild winters. So there's not a lot happening. Yesterday, it was 91 degrees. So yeah, air conditioners are failing left and right because they're being pushed to the limits fairly quickly coming into the spring. So therefore, having that inventory to go out there and do that is key. And then being able to load up early with inventory such that you have availability, whereas maybe none of your competition does, is, is key. So we have lenders that do all kinds of very unique, very specific things. And so that's kind of the differential between working with us and the bank. Our bankers know it. So if they get something where they've got a customer with a unique problem, call Chris. Here's Cardinal's number. Make an email introduction. So yeah.
Yeah, Chris, this has been a great conversation. You've shared a lot of practical insights into how capital actually works behind the scenes, especially in the reality that growth is not always linear. For
Mhm.
listeners who want to learn more about Cardinal Capital or connect with you, what's the best way to reach you?
The best way to reach me is my email address is very simple. It's Chris at cardinalcap.net, or they can go to cardinalcap.cap.net. We have a chat bot where they can enter in their scenario. We have a live person that will respond, and then kind of go from there. But the big thing, Mark, is that whenever you're communicating with somebody like me, the biggest thing is just a very few quick things. Number one, what do you need? When do you need it? What are you going to use it for? How are you going to pay me back? Four things. I need to know those four things. What do you need? I need this amount of money. When do you need it? That's key. Fast money is not cheap. Cheap money is not fast. So that time element is key. So again, what do you need? When do you need it? What are you going to use it for? What are we doing here? How are we going to spend this money? And then more importantly, how are you going to pay me back? And that's those four things are what the banks are looking for. So often, most people don't know what do they really need? And then how are you going to pay me back? The when do you need it piece is always, oh, yesterday.
Hmm.
So we actually help them create a business plan. We do charge fees for that. We create very sophisticated financial models and analysis that we help our clients get loans. And that's what it is that we do. So,
Okay.
yeah, so quite simply through the website, through my email.
Okay, and for our listeners, I will be putting Chris's contact information in the description of this podcast. But Chris, thanks again for being here. I really appreciate your time.
Hey, not a problem, Mark, anytime.